Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Bek, Chief Economist, welcoming you to our 139th episode. We are releasing this podcast in time for the 2024 Singapore Fintech Festival. What I'd like to do is present some updated thinking on the state of fintech, and who better to discuss this other than Varun Mittal. Varun is the Chief Innovation Officer at a leading insurance company where he manages new product and distribution innovation, ecosystem partnerships, and emerging technology rollouts like the AI Center of Excellence. Earlier in his career, Varun served as a partner at EY, leading its fintech and ASEAN digital banking practice, supporting fintech startups, financial institutions, and regulators. Varun Mittal, welcome to Kopi Time.
Looking forward.
Thanks for having you. Varun, give me 1 minute. I want to read you out some things. You joined us for the first time was in 2021, in the pandemic days, 4 years ago, on episode 41. So I took the transcript of this conversation and I asked ChatGPT to prepare a summary of our hour-long conversation. This is what it produced in 1 second. The discussion revolves around the exciting developments in the world of fintech, particularly digital payments. Mittal highlights the significant impact of smartphone proliferation and internet access on the rise of digital finance. He argues that the post-vaccine phase will see a further acceleration of digitalization, leading to a shift towards remote work and distributed workforces. The conversation then delves into regulatory landscape of fintech, emphasizing the need for a risk-based approach to regulate emerging technologies. Mittal discusses the challenges of cross-border payments, particularly the need to balance innovation with security and oversight. He emphasizes the potential of a train model where fintech companies enable smaller customers to participate in existing infrastructure built for institutional clients. The episode concludes with a discussion on the Chinese digital currency initiative ERMB, its potential for cross-border payments, and its implication for national monetary sovereignty. Mittal also shares insights on the digital banking landscape in Singapore, focusing on the potential for innovation in niche areas such as retirement planning for gig economy workers. He further highlights the importance of financial inclusion, even in wealthy societies like Singapore. That's pretty good. Not bad. Let's begin with an update of that discussion. Your prediction that post-vaccine phase will see a further acceleration of digitalization. Well, that certainly happened. Which aspects of the dynamic do you find the most compelling?
The premises, institutions were forced to do digitization, which they could not go back. So all the forms and the processes which became digital, all the non-face-to-face interactions which became digital, normally it would take them 2 years to get the internal approvals. That time, 2 months they had to, but they could not ever go back. So a lot of, I would say, decades of progress happened in 2 years, and which cannot go back, and then that becomes standard. So if we could do it for two or three of these products, why can't we do it for others? So that generational shift which happened across financial institutions, that stays and that becomes the benchmark. And you had 2 of the players to do it, and then everybody else uses that as a benchmark. And regulators also accepted that, okay, we allowed Zoom-based KYC for overseas customers during COVID. So what changed now? We can still allow. So suddenly, if you look at just as simple use cases as cross-border or overseas customers, now that becomes default. And that reduces your cost of servicing, improves agility, improves productivity. And if you look at the ROEs for financial institutions have improved since then. Pre-COVID and post-COVID, you have significantly improvement in that.
By all means. What about geographically? So in Singapore, I think we can safely say some of these things that you just mentioned were very much prevalent. ASEAN?
Even more, because those markets started with smartphones. So, and then everybody was forced to deliver every possible service to them because the branches would just not exist from that perspective. So if you look at today, the number of fintechs who have bought banks in Indonesia is more than the fintechs who have got a banking charter in the United States. Literally half of the lending companies have a bank license or bought a corporasi license, and it's through M&A route, that's fine. But if you look at the fintechs with a banking license or with a board seat or a stake in Indonesia is more than most developed markets.
That is absolutely fascinating. I remember during the pandemic, to your point of, once the genie's out of the bottle, it doesn't go back. My helper used to go every 2 weeks to the money changers to get the cash. When she could not send money home like that, she then became fully reliant on the digital ecosystem that my bank has. And since then, she's always sent money like that back.
It's cheaper for her, faster for her. She can now go there to Lucky Plaza to hang out.
That's right.
But not for this purpose.
Not stand in line for like 20, 30 minutes that we used to see those labyrinthine lines. Absolutely. But between, say, bank-like fintechs that are in the business of giving out loans, but not necessarily in the business of taking in deposits. There was a question, let's say 3-4 years ago, that is there a regulatory arbitrage? I remember having this conversation with you as well. Where do we stand with that, and did the pandemic sort of change thinking around that?
See, the premise is this, right? If there is arbitrage, it's there for everybody. It's the beauty of financial services. It's whatever you do, everything can be cloned and copied if it works, and regulator allows, give it maximum 6 months and everybody will have it. So there is not such case of arbitrage from that perspective. And again, wherever you see, right, where regulators find that, for example, if you see India regulators have put in different measures to control some lending use cases and stuff, because they felt that it was going outside the comfort zone from that perspective. So yes, there would be times where innovators will come up with areas which would be edge cases which have not been factored in before. Sometimes, see, regulators are usually behind the curve, and that's how it's supposed to be, because otherwise it stifles the innovation. But there's a fine balance, and overall, the water finds its level.
I want to actually, to the very end of this conversation, I want to come back to that issue, that balancing part. That's an important one. So you mentioned that the ROEs have improved, both for banks and non-banks?
The non-banks, most of them are not listed from that perspective, but the ones who are listed, if you look at, let's say, United States, for example, right? They have been doing buybacks from that perspective. So if you look at the EPS, for them have grown. So ROE may not be the right metrics for some of the non-banks because they don't have a loan book per se. But if you look at EPS for them over the last 3 years, the EPS has improved. Different metric, but underlying quality is the same.
Right. And the non-bank financial sector in India, for example, is going through massive expansion. What's your sense of their performances?
Right now, it's a growth cycle. There probably might be some, I would say, pit stops along the way. And regulators have identified, like, there are some areas. So, for example, some people, they restricted them from lending or put some extra caveats and stuff. And regulators are looking at it actively. So think of it, right? You have 100 plus NBFCs. If they pick out certain 4, 5, or 6 people on certain reasons, there must be some reasons. And also it sends the message out to everybody else. So not others may be doing it at a smaller stage, but if you say if the class teacher puts punishment to 2 kids in the class, then everybody else...
The demonstration effect.
that sends the message out to the rest of the class. So, and that is there for protection of consumers, right? Because historically, regulators are goalkeepers. They do not get as much credit for the goals they save. They get a lot more blame for the ones they miss.
Very well put. And then coming to our part of the region, so you mentioned Indonesia. We see a lot of fintech-related activities in Philippines and Vietnam and so on, and of course here in Singapore. So give us a sense of the financial performance of this side of the world.
See, overall, if you see, a lot of them depend on non-banks for the source of capital, because not a lot of banks. Now what has happened is banks have started to lend. So if you look at your bank and the bank in the same tower, they've started to give $30-50 million lines to the alternate lenders who are doing downstream lending to the long tail. So when those lenders are able to access that better cost of capital, that percolates it down. So historically, their cost of capitals were 12 to 15%. Now they're able to, they managed to bring their cost of capital between 8 to 10%. From that. So the moment you are having 200 to 400 basis points improvement in your cost of capital, why? Because you have more data. You have proven your NPL record. You have gone through cycles. In credit, it's all about cycles. Right. You have shown that your book did X things all through the COVID cycle, which gives more confidence for the larger financial players to give you those lines from that perspective. And that has changed. So historically, if you look at the cost of capital for the best, some of them, the cost of capital is same. But the best performers have managed to bring their cost of capital in single digit. The not so nice performers still have their cost of capital in double digit.
So I want to go back to India for 1 second. So you mentioned the fact that in this region you were seeing, banks being a source of underwriting for the funding for a lot of non-banks. In India, private capital markets are sufficient for NBFCs to raise money?
That's there, but the banks there are also open. Banks are not averse to that. The thing is, the regulators have put very clear rules on non-evergreening of the loans.
Correct.
So what happened was they found that there were a lot of evergreening of those loans happening. So that's being handled. The Southeast Asian model is slightly different because it's a credit line. And when you give a credit line, it's by nature, it's default evergreen. It's not like a term from that perspective. So if you have already factored all the risks governance in while giving an open loop credit line, which you can draw down upon, then it's factored in. So that was the difference in India. It did not start as evergreen.
Right. Related to that, I remember in that past conversation, I think the ChatGPT summary also picked that up, that you expressed this vision that fintechs will enable SMEs to participate in the infrastructure that is usually reserved for very large financial institutions. I think that was still a work in progress back in 2020 when we chatted. Where do we stand there now?
A lot more has happened. I'll give you an example, right? The number of fintechs today who can issue SME cards is much larger than 4 years ago. Mm-hmm. Because now you have larger players. So for example, if you like say Singapore, right? Faz, which is an Indonesian fintech, can issue cards here. Wise, like British fintech, they are issuing cards for other companies. So Tiger Broker issues cards using Wise infrastructure from that perspective. So the card is one, collections and dispersals is another. So what has happened is the larger fintechs, they have already invested in that infrastructure. So they have ability to rent that infrastructure, and they grew up with a DNA that they are willing to rent that infrastructure. Banks also do it. So now they're competing with banks in some of those places where historically banks would also rent that infrastructure, but they would rent to the person who has 100 million line with them, right. 500 million line with them, or a 18 country bank account relationship, IBG1 client. What fintechs have done is they've brought it down to IBG3 and IBG4 from that perspective.
Absolutely brilliant. Varun, also at the retail level, the same conservative parent who would think twice about finding some not very famous bank name for their child's sort of little wallet. Now, Revolut one day and something other day, people arbitrage between cards, look at the benefits, and opening this account is so easy, but clearly there is a degree of comfort around the security guardrails, otherwise people will not be using these.
Absolutely, and which is why, right? So all of these, they have to store the money with a bank like yours.
Right.
They cannot keep it anywhere else. So there are governance around that this is segregated money and everything. And regulators have put very strong guardrails around how the MPI license. And I'll give you an example, right? 4 years back, the limits for the wallets in Singapore was $5,000 per transaction and $30,000 per year. Now it's changed to $20,000 per transaction and $100,000 per year. So because the infrastructure improved, this use cases improved. So the regulators also felt comfort to move the limits up, says we will unlock more use cases.
That is sort of encouraging side of the developments. What are the not so encouraging side of the developments in the last 4 years?
I would say if you look at some markets, for example, like if let's say India, right? So India has more F&O trading right now, futures and options trading, than some of the biggest capital markets.
That's true.
And as per the Indian government statistics, Indian regulator statistics, more than 90% of these retail people lost money. So how some of the public markets, and even if you look at US, when you see the Wall Street bets and GameStop meme, how public markets started to act like a quasi-casino in some shape and form in different markets. US saw it in GameStop, Wall Street bets, India saw it in F&O, some other markets saw it in different shape and form. So that probably has not been a great outcome from it. The democratization doesn't always work the good way.
Right, and also it is enabled by the speed of transaction and the ease of those interfaces one has.
Think of it this way, right? When you say that this is zero transaction and it's a payment for order flow, then you know that it's a hedge fund at the other side. And it is illegal in most of the European markets for a reason.
Right.
It is legal in some markets, and that's absolutely there is jurisdiction. Right. But you cannot do that in Europe or India for that matter.
But you can use Robinhood in the US to do that.
Exactly. Yeah. Right? But then who suffers? So technically, the retail feels that he is not paying because the cost of transaction is free. But there is on the other side, there is a markup based on the market making from the hedge funds from that perspective. So, and I'm not saying there is nothing illegal about it. That's the United States law, and each of those entities are subscribing to the law of that land. I'm nobody to say whether the law is right or not. But what that does is a lot of people who do not have enough financial literacy, who do not have financial awareness, and who have a lot of these TikTok and Instagram influencers.
Right.
So the problem of the financial uncontrolled access and awareness is you have a lot of non-doctors prescribing medicines of financial freedom and FIRE movement and different ideas and different Telegram groups and courses and everything, who probably may not have the bad intentions, but they may not have the enough knowledge and awareness to do it. So one side, that ease of access with I would say non-sensitized information,
right?
From that perspective, and there is no governance around it. So if you're doing medical advice, there are regulations around it, but I have not seen much enforcement. There's some enforcement have started to happen in India now, but there's a lot more gap which needs to be happen for governing. And whether it's TikTok, YouTube Reels, Instagram, it's all same family of those influencers telling people do this, and platforms saying, I'll make it happen. So the traditional definition of accredited investor, sophisticated, CKA, done 15, 20 years ago may not fully be relevant for the Instagram, TikTok generation.
Right. Actually, so that will lead me to a discussion on so-called democratization of wealth management, but I'll come to that a little later. I want to talk about one thing before that, because you and I had a long discussion about not just payments, but also digital currencies. And we talked about eRMB at that time, and it seemed like eRMB was going somewhere at that time. Mm-hmm. And we talked about the digital wallets that the Chinese mobile phone companies have, and how even somebody sick in Africa could do payments and settlement with some Chinese e-commerce provider. That hasn't really gone very well, has it?
It has. It's just now called stablecoins. Technically, central bank is the one issuing the currency. Right. It is running on a proprietary rail. The underlying custody of the whatever is the fiat currency is with a financial institution governed by the central bank. What was called the national CBDC, the central bank digital currency, is now stablecoins.
I think the difference is that they can choose to issue or not issue, which is a central bank decision, whereas a stablecoin, a private sector entity can carry that out.
But the actual underlying fiat is still sitting with the bank.
Right.
The funny joke was that one of the US stable coins suddenly came up announcing publicly, I can't verify it's true, that they are one of the top 10 US treasury holders now. Because they parked all the money in US treasuries. Right. And over the last 3-4 years, they became profitable because the treasuries were making so much money just by holding on to them. They could make so much. But now what has done is, there's enough democratization there. Because now there are companies, Stripe just acquired one. There are companies whose core job is to help you build and run a stablecoin infrastructure. And you can run it in multiple currencies and stuff from that perspective. And as long as the money is one-to-one collateralized, auditable in that bank, it's much simpler way to run that from that perspective.
So are you saying that on digital currency, the private sector sort of leapfrogged the public sector, and the public sector sort of fallen behind, and you can, if you want to one-to-one match to a domestic currency, a stable coin provides a solution as good anything that the central bank can offer?
The question is, central banks are not averse to that. Central bank's objective was to reduce the middleman fees, to reduce the American oligopolies fees on merchant transactions from that, like that's in one use case, right? They want transparency. So anything which is digital and trackable is transparent. They wanted less oligopoly. They wanted less fees for intermediaries. All of that, those objectives are all getting achieved from that perspective. So there is nothing wrong about it. So regulators can central banks can still do it. Nobody's stopping them.
Right.
But if, for example, people build specific use cases. So, for example, if you want to build a stablecoin in e-commerce use case, A government will not wake up in the morning, let me allow you to buy toast and allow you to buy food and shoes on e-commerce website. Because you need to build a lot of use case. Okay, how does the authorization work? Hold work, refund work. That's a lot of infrastructure around that, right? And when, for example, it's multi-party transaction and you need to cut a part as fees, another part needs to go. And you want to have maker-checker flows.
Right.
So there are a lot of this workflows which needs to be built along, and it's great that the private sector is building it. And private sector is happy to build it even on the central bank digital currency. Central bank digital currency or private currency backed by the central bank fiat are different instruments for different vehicles. The government ones, for example, if you look at Thailand, for example, right? Those are very usable when it's direct benefits transfer. There are merits for the government use case. Direct benefits transfer is a massive use case across markets. You look at America, from United States to Thailand to India to China, the direct benefits transfer is a very large impetus. And when you are looking at a post-inflation side of environment and stuff and welfare societies picking up, there's merit for that. So central bank digital currencies can do that use case.
Right.
Targeted subsidies. Private builds its own.
Right. Targeted and sometimes digital coupons. Like in Singapore, we got these $500 showing up into our accounts, but it had to be used within the year, and it had to be for a specific purpose, using in local hawker center or local grocery stores. I found that very...
That's purpose-bound money.
Right.
Purpose-bound money can be on central bank digital currency as well as private currency.
Sure.
And private markets always had purpose-bound currency. So you had airline miles as an example of purpose-bound points.
Yeah.
Can be.
Hotel points as well, yeah. Okay. Since I alluded that we're going to come to this issue, and now I want to talk about that. Fintech and wealth management, and fintech and financial inclusion. Let's talk about these two. It seems to me that these are two ends of a spectrum. One is for rich people, one is for poor people, but maybe they're not that far from each other.
I'll give a third dimension to it. So financial inclusion also looks at, can they access insurance benefits? Can they access the right protection needs at the price they can afford, in the format they can afford from that perspective? Can their employer enable that? And Singapore is a perfect example. So Singapore just mandated that all ride-hailing and food delivery drivers and workers will mandatory get insurance coverage and will mandatory have CPF contribution from their platforms from next year. That's financial inclusion at max scale.
Right.
And you're talking about more than 100,000 drivers and delivery people and their family members be getting impacted. And you can imagine, right, this is not the top end of the market.
Correct.
It's somewhere in like middle, lower middle, somewhere there. And it's financial inclusion at its rates. And CPF, it's retirement, but I mean, there is an interest element, there is an accumulation element onto it, there is a retirement element onto it. So I would say there are a lot of those kind of initiatives which have happened. Broadly, to be able to buy funds, ETFs, or stocks, that's democratized enough. If you want access to it, you will have access to it. There'll be enough providers in every market for that.
Right.
That, I would say, is table stakes. The question is, what can you do beyond that? Can you help people access more things around systematic withdrawal plan? When people want to have something as an additional layer to the government pension plans in each market, in an inflationary environment, what can you do along with that? What solutions can do that? Because you see, the upper end of the market is all about access and pricing.
Right.
If you are worth $2 million, $3 million, you should be able to access most things, not all things. And the more you go up, the better terms you get, the better access you get, and that's a simple ladder curve.
Right.
And that curve is simple. Everybody will keep trying to compete with each other. They will go and try to find you allocations for something. So that I would not worry as much per se. They will figure it out. And they have enough. On the other side of the spectrum is where a lot of fintechs are coming with very interesting ways to support these people. Like, for example, how to build credit score for these people. Because they don't have salaries.
Right.
Historically, banks look at salary data. Salary doesn't exist. If you are driving for taxi company or delivering food, even your bank statement does not say salary. Every day something is getting hit. Correct. Because it's daily settlement.
That's right.
How do you do credit scoring for this? Can you have credit builder products? So if you see Philippines, India, there are a bunch of companies whose only product is credit builder. Based on your incomes and expenses, they will start to report it to the bureaus for you. And they will charge you a small fees and they will help build a score for you. so that you can be financially included to be able to access credit from the proper sources instead of non-traditional sources. And larger financial institutions are happy. They're like, we are happy if there is score for these people.
Correct.
Life is much simpler for us. We want to extend credit.
Right.
We'll thank you for building the score for these people.
Right. Okay, so one end, low end of the income spectrum, gig workers, and are there certain provisions for them? Can that be done? And there are some solutions around that, particularly product access insurance. And at the top end, you're not that fussed about it. The market devotes huge amount of talent, and well, there people will get nice interfaces, right? Let's talk about the third segment, which is the mass affluent. We see in the US, for example, the whole Robin Hood phenomenon, which probably has appeal to the aspiring, youth as well as others who want to be wealthy and want an interface or an experience through which they can sort of buy all sorts of products. Doesn't have to be meme stock, perhaps even something more sophisticated.
No, you can buy presidential derivatives.
That's right. That's right indeed.
That's gambling in my world.
Correct. Absolutely. But what about your point that as you get wealthier, there are certain access you get? What do you think of apps that are trying to reduce that barrier, that even at a lower cost, you can access certain things that only the very wealthy couldn't?
See, always a question, was the barrier the cost, or where's the barrier sophistication of understanding of the product?
Was it there for a reason?
Right? There is a new app which recently launched. They put structured products without advice. You can buy structured products without talking to a human being from an app, which includes knockoff and kick-offs from that perspective. Great, technology can solve a lot of things, but there are side effects also from that perspective. So my view is technology can solve a lot of these things. So I'm not worried about technology lowering the cost of those things. But not everything which can be done digitally should probably be done digitally.
Right, and so investor knowledge, investor education.
And suitability,
Right.
investor suitability. Right, because let's be practical, right? If people are clicking 3 checkboxes in the app, how many times have you read the full terms and condition when you downloaded an app or created an account?
Never.
That's the whole point, right? So, which is why we have to accept that that's the reality of truth, and that is where the whole point is this, right? Nothing about Wall Street bets most of things I don't think were illegal, but did they hurt enough ordinary people? Yes.
Right.
The FNO is not illegal, but does it hurt 95% of the people who are doing it? Yes. So, which is where there is a reason where the regulations come from that perspective of sometimes the full free markets may not always be right.
So it's interesting, the conversation that we have had so far, I don't think we've used the word AI or GenAI even once, but when I think about the latest chapter in the Global Financial Stability Review of the IMF, just came out last Thursday, the whole chapter is about impact of AI and GenAI on trading, importance of regulation, and need for greater transparency on exactly what kind of model banks are using and so on. So let's have a little discussion about your thoughts on AI/GenAI and how it's sort of fusing itself into the fintech world.
See, AI today is what internet was in 1999, 2000. There will be a lot of capacity being built up. There will be a lot of vision. There will be relevant winners. There will be relevant use cases. But sometimes the world runs a bit ahead.
Right.
There will be use cases, absolutely phenomenal use cases, which will happen. But it will take time from that perspective, because AI still can't do my laundry. AI still can't do my dishes. And there is an element. And when you're doing all of these new models, they're generating new stuff based on the past trend data. So when you're doing search use cases, when you're doing unstructured search use cases, absolutely. Some of the existing jobs will become a lot more simpler. More productivity will happen. And the way I would say is more content will be created, so then you will need curation as a service.
Right.
So, as simple. So then you will curation as a service, because if everybody is sending you emails written by ChatGPT, which are 3 pages long, to ensure that no point is missed, then you will use another counter service to say summarize and list the key points.
Right.
So the swing works both ways. There will be relevant use cases, and it would take time. Financial institutions have already started. Financial institutions probably were the first ones among the industry, them and pharma, to start to use heavy computing power to take decisions, credit decisions, and all of those. So all of that will continue. There will be absolutely relevant use cases, but will we be in a bright, new, shining world tomorrow morning where there is a whole new lens? Even printing press did not do that. Internet also took a while.
Right.
It took a while, and there will phenomenally absolutely be winners. But it's not that tomorrow there is no humans and AI is doing everything.
Let me ask you a broader question, which is today when we look back the first quarter century of the internet, especially when the proliferation of social media, we now have some regrets looking back that in terms of mental health of young teenagers, we probably did not put enough guardrails around social media, and it has, certainly in the Western world, but maybe all over the world, it's been an issue affecting our children in particular. Do you think that having been chastened by that experience, regulators will be a little more sort of intrusive with the AI processes?
They would like to. So there was a recent case of one of the AI companies being sued because the AI companion got... I would say misguided the kid to commit suicide.
I just read about it, yes.
Right. So, but the challenge with this thing is a lot of these models are open sourced. You could pick the model and run your own service. Who is liable?
Right.
The company operating the model, the company who built the model, and you can't track what's the sources of data. So, and again, same thing happens with social media. I don't think Mark Zuckerberg creates a content which is causing a mental health problem. It's the content created by people on the platform, not an employee per se of Facebook or TikTok for that matter, right? So the question is, where does the liability stop? So the regulations needs to look at, are platforms liable for misinformation on their platform? Now they're taking a position that yes, you are.
Right.
Earlier the position was no, you are not.
Right.
Right? So there will have to be positions on that, and there needs to be right balance of what is freedom of speech and what is censorship. And that's a debate which America is figuring it out in their own way, Asia is figuring it out in their own way. And I believe it would dwell down to country levels, because the definition of what is freedom is different.
Right. But let me just draw a parallel back to in the world of fintech, that a Robinhood type app, which initially was, the criticism was, it promotes addictive behavior. It's a bit like, Facebook promotes addictive behavior. You keep on looking for likes and keep on looking for new feeds. Similarly, that, in a gamified environment, you feel like going to that app all the time, and it shows you second by second how much your wealth is going up or down. That sort of stuff, would we see some degree of friction being imposed by regulators?
It's tough to regulate it. Because you can't expect regulators to come and check every screen of the app. And the
UI UX part, yes.
It's not reasonable and practical from that perspective. They can, for example, require, like for example, you see, in Europe, if you're doing CFD trading, they would make you accept a disclaimer that that 80%, more than 80% of the customers who do this lose money. So it's like that. So you can put up the warning in your face on a cigarette pack, but either you're banning the cigarettes. If you're not banning the cigarettes, you can put that warning. But then if somebody goes and still does it, and does it as a cautious choice, you can put up an age limit. So let's take an example, right? Cigarettes. You put an age limit. You can even say like only from this time to this time. I'll check your ID while I'm selling you. I'll put an image of like this swollen lung and everything. But if you still do it, then there is a layer to which you will defend the person, and then after that is the freedom line.
Right.
So I would not expect the UX layers to get, but you cannot have confetti dropping. Okay, then I will have stars dropping. So I don't think it will go there, but probably more on acceptance, like, okay, every month they need to do it. It could go even to the level of every time they log into the app, the first screen needs to say, you acknowledge that you're doing this. I mean, that's the extreme I couldn't think of.
Right.
But I don't expect them to come and start designing apps for people.
Right. Earlier we were talking about the transparency associated with, we were discussing in the context of the stablecoin, and you were mentioning that, the regulators want lower cost, transparency, and the digital ecosystem builds it. But Varun, in terms of the crypto ecosystem, that's where the ransomware and the cyber attack related to payments, everything seems to be taking place. So clearly that, despite being a digital distributed ledger where you can see things going on, there are ways for people to hide behind them. So talk a little bit about where you think the crypto ecosystem has evolved in the last 4 years, and how do we deal with this issue that seems to be a lot of illicit activity is in that ecosystem?
See, yes, there is, but honestly, they get a lot more blame. Nobody took a ship full of cash to Panama. Though historically money laundering happened through the financial institutions, through the proper channels and everything. So it's not that crypto are the only people. There are wrong things about their systems, absolutely. And which is why there are companies who are doing this tracking analysis. How could FBI recover a lot of that during their investigations and everything? Even when you see an FTX thing happen, they could track a bunch of the assets and stuff. They could do that. Honestly, you can't do that with cash. You can't do that with cash. With crypto, at least you have some trail. Is it the perfect trail? Maybe not. Maybe not. You have concepts like mixers and everything, which can be used to obfuscate the thing. But is it better than cash? Most likely, yes. Should there be more guards? Absolutely. On the on-ramps and off-ramps, most regulators are putting the guardrails on the on-ramps and off-ramps. Because if you keep circulating in the crypto ecosystem, yes, but the moment you have to come back outside, then at the entry and the exits, you can be asked to justify and stuff. Details from that perspective.
Should cross-border transactions of fiat versus cross-border transactions of crypto be treated differently?
It's a sovereign matter. Some countries have control currency, some countries do not. So try to remit IDRs freely out of Indonesia is very different than you were to do remit Sing dollars out of Singapore.
Right.
So that's a sovereign matter. It's not a question of crypto or fiat. It's a federal. It's a sovereign matter.
But do you see instances where, let's say, hypothetically speaking, we have some terrorist incident somewhere in the world, and we realize, just like in 9/11, 24 years ago, the Western Union was the payment method with which the terrorists did the financing, that we see this time it's done through the crypto ecosystem. Mm-hmm. Could there be a massive backlash then?
See, premise is this, right? There will be a fraction of the transactions on that. And from that, question is this always, right? What was the on-ramp and off-ramp? Western Union is still not banned. Right? It's
correct.
Right? There were probably issues which were rectified and everything, but it still operates. They just acquired a large payment player in Singapore last week. So there are gaps. There will always, it's a Tom and Jerry game. They will always find something, and it will always be a chasing the mouse game from that perspective. But that doesn't mean the platform needs to be shut down. There are gaps, fine. We find gaps, we fix them. And it's not that enough financial institutions have been penalized for hundreds of millions and billions of dollars.
Nothing to do with the crypto ecosystem, yes.
For supporting some country or remitting money to a country which was on the sanctions list, which had nothing to do with crypto. So, did we shut down that global bank with a 150-year-old history? No. Yes, there were punitive actions. There were mitigation measures put in place. It's the same thing, right? It's the same yardstick.
Right. So you're fundamentally differentiating between technology, which you're basically saying is innocent, and then there are actors which you say could or could not be innocent. But I just want to harp on that issue one more time, that when we say that the technology is innocent, but there could be algorithms that can promote addictive behavior. There could be algorithms that can help you hide things.
Absolutely.
And that's where regulation comes in.
You see, in China, for example, they put a restriction that the kids below this age cannot do online gaming.
Right.
Right? They put the regulation. And yes, because those games were addictive and stuff, they put the regulation. They put some caps on the number of hours per login for spending on certain platforms to control the addictiveness in the young children. Absolutely, I fully agree. And each country will have to take a call for what is that threshold. The threshold will be different by different markets.
Since you mentioned China, let's conclude on China. The tech crackdown over the last half a decade has seemed to take some shine away from the entrepreneurial energy that we used to see in China in the previous decade. But at the same time, TikTok is a global brand. It's so big and influential that, some countries like the US think about banning it.
Temu.
So let's talk a little bit about the vitality of the Chinese fintech ecosystem.
See, I would say it's a very large domestic market. Over the last few years, they have invested in assets across the world. One of their assets in Philippines recently was valued at $4.8 billion, which technically is worth more than all of Gojek's worth.
Right.
From that, and Indonesia is a way bigger market from that perspective. So some of those assets have done well from that perspective. So from that perspective, it takes time. There's cycles and stuff. And as an economist, like you've seen the whole Japan cycle come through. Sometimes there are economic cycles where some countries are balancing society and progress and definition of progress from that perspective. And there is a reset which happens in that. And if you look at from the regulator's perspective, right, there was a point where the regulators lost fair level of visibility to M2 money supply. Because so much transactions were happening through the two large wallet ecosystems that when the central bank starts to lose visibility on M1, M2 money supply controls and throughputs and thresholds from that perspective to be able to define how do you manage the interest rates, that's the time when the regulators have to come in that, guys, we embrace private sector, we acknowledge all of this, but there are areas which we need to manage because we have to manage holistically from that perspective. So that's, again, checks and balances.
What we have seen, the checks and balances in China, is that a harbinger for other regulators, that they would also do some things like that?
Some of them, it depends, right? So if you look at it, some of them, for example, they started to put limits on social media usage or gaming age limits and everything. So those cultures who can accept those kind of limitations will start to do it. However, you will see some cultures who will be very against it, who will revolt at the idea that this is my definition of freedom, of speech, freedom of expression, freedom of access. So it's a way, that's their model. India has another model. India just banned TikTok straight away. But equally addictive Instagram Reels and YouTube Shorts are allowed from that perspective. So some countries will do that model approach. Other countries will do differently.
I'm thinking in terms of non-bank financial sector's extension of credit, and that somehow becoming loosely attached or more loosely attached into the monetary transmission system. So to your point, that PBOC was getting worried about losing control over broader money supply, would we see elsewhere?
I do not see non-bank players to be that strong in other markets to be able to cause that level of worry.
So Alibaba, Tencent were different from it.
They built the financial infrastructure rails. So when the internet commerce boomed and everything, they literally built the social media rails, e-commerce rails. So they built the highways. They built the highways from scratch. Versus, let's say, take Thailand, right? So PromptPay was built not by one company.
Right.
InstaPay in the Philippines was not built by one company. UPI was not built by one company. It was a collection of like 20, 30, 40 banks per se. And NPCI is not owned by one individual from that perspective. PayNow was not built by a bank or a fintech. Yes, everybody was involved, but it was not like DBS owned it or OCBC owned it or Wise owned it, right? So, which is why a lot of regulators learned that lesson that some of these public infrastructure needs to be supported and led by supported and nudged by the government. The private sector can have equity stake in it, but they need to be there on that to enable it. Otherwise, private people will build it and then you'll have to come later to regulate it.
Correct.
So the lesson for the regulators was that embrace it soon, control it, govern it, and you drive the direction of it, rather than wait.
I think that's a very good lesson, and I think that's a very good point to end our conversation. Varun Mittal, thank you very much for your time and insights.
Thank you so much. Thank you.
Thanks to our listeners as well. Kopi Time was produced by Ken Delbridge. Violet Lee and Daisy Sharma provided additional assistance. All 139 episodes of our podcast are available on YouTube, as well as on Google and Spotify and Apple. For our research content, you can find them all by Googling DBS Research Library. Have a great day.